Hi, welcome. What I'm going to try to do here, this is chapter 10. I'm going to try to simultaneously record my screen as a video that I'll put on YouTube as I go through the slides. And at the same time, I'll record just within PowerPoint, just my voice. So you can have both options if you like one better. All right, so chapter 10 is about property acquisition and cost recovery. You can think of it as mostly being about depreciation. I'm recording this before the second midterm, so I'm hoping at this point you're feeling good. You're not feeling like that. Ouch. Yeah, hopefully that's not you. All right, so when we're talking about depreciation, it's only going to be for businesses, right? Only businesses can deduct depreciation and amortization and depletion. All right, so it's going to be a business expense, so it's going to be above the line for AGI, all right here in our formula. Right, cost recovery is our overall term we're going to use for this. This happens because, right, we know if a business buys something big that's going to provide a benefit for more than a year, then they have to recover that cost over time, even on the cash method. Because the expense can be so big, our default rule is they're not allowed to deduct it all at once. They have to match that over time. All right, so that's going to be called depreciation. If it's tangible, personal, and real property, we'll talk more about what that means, other than land. Amortization is going to be cost recovery for intangible property, and depletion is going to be for natural resources. But what they're all doing is recovering the cost of an asset incrementally over time. The depreciation, amortization, right, cost recovery, it starts right when you put the asset in service. So not necessarily when you buy it, but when the asset goes into service, right, as being used in the business. That's when cost recovery begins. Just wanted to let you know, I sure do depreciate you. Hey, depreciation humor is tough, okay? So basis is our starting point for cost recovery. The basis, right, is what we're deducting as an expense over time. Our basis starts as our cost. What did it cost us to buy the asset? And this is going to include all the costs that it took to actually put the asset into service. So if you bought something and there was a shipping cost, there was installation charges, or you had to modify it, everything that it took for you to put that into service in your business, that's going to be your initial basis. From that point, the basis could increase if you make additional capital investments, right? You make large expenditures that expand or modify what the asset can do, right? You add on to a building, for example. The basis is going to go down. Most importantly, what will cause the basis to go down, right? It's going to be our annual deduction for things like depreciation. All right, because we could have increases, but especially because we'll commonly have decreases from our annual cost recovery deductions like depreciation, that's why we get, right, you've heard me use this term before, we have adjusted basis. All right, it starts with our cost of putting it into service, right, but that can be changed, so our adjusted basis is the most recent number. All right, so most commonly, adjusted basis, right, in all our problems, it's going to be the cost of acquisition minus accumulated depreciation will give us adjusted basis. So let's take an example. Scrap Happy is a scrapbooking retail store. They purchased an old office building for $175,000. right, to use in their operations. All right, I'm going to start over here for the purpose of the PowerPoint recording. So Scrap Happy is a scrapbooking retail store. They bought an old office building to use in their business. They paid $175,000. They paid another $10,000 in real estate commissions and other fees. They also spent $15,000 to remodel it to prepare it for opening for their business. 2 years later, an employee discovered that several leaks in the roof were causing serious water damage to the store's inventory. The company spent $50,000 to re-roof the building, right? Get a whole new roof. Every 6 months, they pay $500 to have the carpet professionally cleaned. So what is the basis of the building? It's going to be what they paid for it, the cost, right? The things like real estate commissions and fees, and they're remodeling it, right, to put it into use before they ever use it for their business. They had to do some painting, some alterations, all right, to really make it into what they needed it to be. So they'll have an original basis of $200,000. Now this, right, this is assuming that this initial cost was only for the building, right? And this doesn't include the land. So the roofing expense, right, because we're assuming that gives them a roof, right, that's going to last now a long time, right? It's a significant addition. We're going to call it a capital investment. That's going to get added to the basis, and it will have to be deducted over time. The periodic carpet cleaning, that's just going to be, right, an expense that they deduct currently each year. All right, so what assets can be depreciated? Right, it has to be used in a trade or business. It has to decline in value or have a determinable useful life. All right, so the second one here is going to mean that basically land is not going to be depreciated, right? Because it doesn't have a fixed useful life, right? And doesn't decline in value. Buildings, right? In some areas, real estate doesn't really decline in value most of the time, but the building itself, right? Because there's wear and tear, because they break down, they can be depreciated. All right, so here's something that's going to come up that's going to be confusing. When we say personal property in tax, what we mean is it's not real property. We don't mean that it's not business, right? Because a business can have personal property. So personal property are things that are movable, right? So it's things other than land and buildings, right? And all right, so a vehicle would be personal property, equipment, furniture, clothing, that would all be personal property because it's not real estate. Real property then is going to be land and buildings, right? So personal property and real property are going to have different rules for depreciation. So the confusing thing here is that personal property, it could be business personal property, it could be personal property. So to try to make that as clear as possible, we're going to say business use or personal use. Business use things, or things used in a business, can be depreciated or amortized. Personal use things cannot. Real property, right, the same. Your personal house, personal use, real property, you can't deduct depreciation, right? But if you have real property used in a business, it's business use property and it can be depreciated, right? The buildings, not the land. All right, so you may have heard this misquoted from The Godfather. What he actually said was, if it's not personal property, it's just real property. Right, common mistake. All right, before 1981, depreciation for tax looked a lot like depreciation for financial accounting. The business would have to estimate a salvage value and a useful life, right? But obviously in tax, right, there's a lot of incentives for people maybe to estimate a useful life that's too short, right? They want to depreciate as much as they can, as quickly as they can. And so everyone would do something different as well. So to make it simpler, right, the tax code came up with something called the accelerated cost recovery system. Right, so all of the IRS basically is going to determine what your useful life is. Right, and so all assets are going to fit into a different category, and that category is going to have a set useful life. Right, which it makes it pretty simple for us. We just have to look up what kind of asset we have, and it'll tell us. Today, it's been modified a little bit. We call it the Modified Accelerated Cost Recovery System, right, which is pronounced as MACRS by tax accountants. MACRS might have been better, but it's too late at this point. The other thing you see here, though, is it's accelerated, right? So it's not going to be a straight line depreciation over probably the real useful life. You get to take more depreciation early, and the useful lives are relatively short for a lot of assets. So if we want to compute MACRS depreciation for an asset, we have to know a few things. Determining these things is the hard part. Once we got them, we're just kind of plugging things in, looking at tables, and it becomes very simple. We need to know the original cost, right? The original initial basis. We have to know what depreciation method we're using. We have to know the recovery period, which we're going to just look up from a table. And we have to know what the depreciation convention is. The convention is going to tell us what to do in the first year and the last year of the asset's life. Right? But since the taxpayer doesn't own it for the entire year, we have to do partial depreciation, and the convention tells us how we're going to do that. All right, so you can remember cost, convention, and recovery period, CCR. And obviously method man is in charge of methods always. All right, so if we're depreciating personal property, right, so not real property, and we're also going to exclude intangible assets, right? So we're talking about tangible property like computers, automobiles, furniture, machinery, equipment, most things other than buildings, right? If it's used in a business, we can depreciate it, right? But no, right, this doesn't include accounts receivable and inventory, right? They're not, right? Those are short term, generally, not long term. All right, it's also, I mean, I'll give it to you that Vito Corleone does mumble a little bit. Some people think he says it's personal property used in a business. That's what you can depreciate. All right, method. 3 acceptable methods, right? The tax code allows you to do 3 different things. You can do a 200% or double declining balance method, right? Obviously, this is going to be preferred if you have income, because this is going to give you more deductions faster. And so in most of our problems, we're going to assume we're using the 200% double declining balance method. That's going to be our default. You can also choose to use 150% declining balance. You might want to do that because under the AMT, you have to use that method. And so if you know you'll be subject to the AMT, then you could do that so you don't have to use 2 different methods. Straight line method, right? Obviously simple to understand, and you can use it if you want. You have to use it for real estate. All right, so we're always going to assume the 200% double declining balance for personal property. Real property will always be straight line. or right, method man is watching. All right, so here's, right, we're gonna actually get our numbers when we have to figure something out. We're gonna look up tables, it's gonna be simple. All right, this is just so we understand where the numbers are coming from. What does double declining balance mean? Suppose we have an asset that costs $10,000, its useful life is 5 years. Right, in year one, right, straight line depreciation would be 1/5 of the cost, or $2,000. So a double declining balance will double it, and your depreciation would be $4,000 for year one. That would be the full year number. All right, we're going to alter that a little bit with conventions. Right, in year two, right, we would use the adjusted basis, right, initial basis minus accumulated depreciation, right, over, right, straight line over 5 years, that'd be 1,200. If we double it, that's 2,400. Double declining balance. Under the maker system, right, it's pretty favorable for taxpayers. And so at the point, right, obviously there's a point in this accelerated depreciation, right, it gets a little bit less each year. There's a point where straight line is bigger, right, in later years. Well, under makers, you switch to straight line when straight line does become bigger. As I said, it's generally geared to give you more deductions faster. Right? Note, right, we're going to adjust this when we talk about conventions, and it's going to be pretty simple. We're just going to look at tables. All right, so the recovery period, it's not something that the taxpayer estimates or figures out. All right, we look, the IRS has issued a revenue, right, they issue revenue procedure that puts all assets in different categories and tells you what the useful life is. Right, for example here, office furniture, right, we can see there's some, right, we have a general recovery period, we have an alternative recovery period, right? We're generally looking at this general recovery period, right, even though the life is 10 years because it's accelerated, we're gonna recover the basis in 7 years. So this exhibit 10-4 from the book is what we're usually going to use to look up the life of assets, right? So this will usually be, we'll try to keep this handy. So for cars, for example, they're going to have a recovery period of 5 years. Machinery, 7 years. Computers, 5 years, right? So it's really just a matter of looking it up in the table and figuring out the recovery period. Okay, the convention, as we said, tells us how do we figure out partial depreciation for the first year that we have the asset and use it, and the last year. So the half-year convention is what we're generally going to use for personal property, right, used in a business. We're going to take what the full year depreciation would be, and we just cut it in half, right? So it's really simple. So it doesn't matter when during the year, it could have been January, July, or December, right? It doesn't matter. We're just going to take 1/2. When we're using the IRS tables that we'll see, they always do this for you in the first year. And if you fully depreciate it until it's fully recovered and don't sell it, they'll do it for you in the last year. We only have to apply the convention ourselves if we sell the asset or get rid of it before it's fully depreciated. So a lot of the times the table will do all the work for us. Right? But if we sell it early while we still have basis, then we have to take our full year depreciation, and the half-year convention says we cut it in half. So the half-year convention is our default rule for personal property. Right? If we see some non-real estate, tangible business property, we're going to assume we're going to use the half-year convention. All right, so right? We can take Tyson, say he purchases and puts into service a piece of machinery for his t-shirt printing business on February 11th, year one. All right, so we'll say machinery, that's 7-year property. That's our recovery period under 200% double declining balance. All right, 7-year recovery period. All right, so that means he's going to take half of the full year amount in the first year, right? Which means, right, this is not going to be fully depreciated until year 8, when he also gets a half year's worth of depreciation, right? This is the half year convention. If he were to sell it in year 4, right, then he would take the full year depreciation divided by 2, right? Cut it in half. Whenever in the first year and the last year, right, we have to use the convention. The first year, the IRS table will always do it for us. All right. So this is a table, all right? This one was a nice condensed table from the book, right? The IRS publishes, right, bigger tables. It's going to tell us, right? So these are recovery periods. These are going to be our most common ones. For personal property, 5-year and 7-year, right? And so all we have to do, right? Let's say I have 5-year property. I'm going to take my initial basis, and for year 1, I'll multiply by 20%, right? So these numbers, it's not really clear here, but these are percentages. So I'll take my basis times 20%. That's my depreciation deduction for that asset for the year, and I'm done. And I don't even have to keep track directly of my adjusted basis for purposes of calculating depreciation each year. In year 2, I'm going to take my original cost, right, initial basis, same number, multiply by 32%. Year 3, same number by 19.2%. And if I keep it right through year 6, I'll multiply by 5.76% that year, and I've recovered my basis and I'm done. All right, so on this table, assuming you keep the asset the whole time, they've already applied the half-year convention in the first and last year. If I sell the asset early, right, in one of these middle years, then I'll have to use this number and divide by 2. All right, our next convention is called the mid-quarter convention. Instead of half year, we're taking half a quarter. All right, so in whatever quarter you place the asset into service, I get half of that quarter and then the rest of the quarters of the year. Right? That's my proportion of the full year's depreciation. When I sell it, I get half of the quarter that I sold it in and any quarters that came before that year. All right, so we're being a little more precise. For example, if I purchased and placed in service property during the first quarter, I'll get half of the first quarter and the next 3 quarters. I'll get 3.5 out of 4 times the full year. All right, second quarter would be half plus the next 2 quarters, 2.5 out of 4. Suppose a $10,000 piece of 5-year property purchased on May 15th, year 1. All right, so May 15th is the second quarter. Right, under the double declining balance, right, we showed how for a $10,000 asset with a 5-year life, right, the double declining balance appreciation for the full first year would be $4,000. All right, but if we're using the mid-quarter convention, right, since this is the second quarter, we take half of the second quarter plus the third and the fourth quarter, right? So that's 2.5 out of 4 quarters times the full amount gives me $2,500 of depreciation I deduct for that asset for year 1. So we said half-year convention is our default for personal property. The mid-quarter convention is going to be used on some personal property. This is going to happen if more than 40% of all of the personal property that I placed in service that year was placed in service during the fourth quarter. Then I have to use the mid-quarter convention on all of my assets placed in service that year, right? If I don't do more than 40% in the fourth quarter, I use half year for everything. But once I do more than 40% of all the assets in the fourth quarter, I have to switch to mid-quarter for everything. You can see what they're doing is, right, companies, right, if it was always just half year, companies like to be clever and, right, maybe put some assets into service on December 28th and get a half a year depreciation, even though they didn't hardly even have it that year. All right, so this is going to make it so if you have a lot in the fourth quarter, you're going to have to be more precise and only get a half a quarter's worth of depreciation. All right, repeating what we just said, the mid-quarter applies when we have personal property and more than 40% of the dollar value of all the personal property placed in service that year was placed in service in the fourth quarter. Then I have to use mid-quarter for everything. Those assets, right, are going to be under the mid-quarter convention for the rest of their life until they're fully recovered. So this is the table from the book that we'll use to figure out our mid-quarter convention. It's a little more complicated, but still really simple, right? The hard part is calculating that 40% threshold and identifying, okay, hey, the mid-quarter convention applies here. So I'm going to look at this table instead of the half-year table. All right, so let's say I had 7-year property, all right, and it was placed in service in the second quarter, but I had enough property placed in the fourth quarter that I have to use mid-quarter for everything. So for that 7-year second quarter, I'm going to use 17.85% times the initial basis. Year 2, I'll take initial basis times 23.47% until, right, every year, I'm always just using initial basis times the percentage until it's fully depreciated. If I keep it, right, for its whole useful life, the table has already done the mid-quarter convention for me in the first year and the last year. I only have to figure it out and apply it myself if I dispose of the asset before, right, in one of these middle years. We'll do some examples of that. Our last convention is called the mid-month convention. Same logic, but we're getting more granular and we're going by month instead of quarter or year. Mid-month convention, we're going to use it for real estate, real property. That means, right, let's say I buy a building and I put it in service in March. I'm going to get half of March and then all of April through December. All right, so I'll have 9.5 months out of 12. 9.5 over 12 times the full year depreciation. All right, that's what I just said. If it was October, the 10th month, I would get 1/2 of October plus November, December, 2.5 out of 12. And now if I'm selling the real property, it's going to be sort of the reverse. Let's say I sold it in March, then I'm going to get half of March plus what came before, plus February and January, 2.5 out of 12 times the full year number. All right, so let's say I bought a piece of real property. It cost $97,500. That's my initial basis. And I placed it in service on May 15th of year 1. All right, just take it, my word for it, that the full year depreciation would be $2,500. And so the mid-month convention is going to take half of May and the rest of the 7 months, right, June through December. So 7.5 out of 12 times the full year gives me my yearly depreciation deduction. Year 2, I'm just going to get a full year of depreciation, right? And so on until perhaps I sell it or it's fully depreciated. So this is a table that we can use for for non-residential real estate, right? For it has a 39-year life, right? So in the first year, they've already applied the mid-month convention for us, right? You can see that's why the number's different. In the middle years, right, it's always going to be the same. And if we keep it for its whole useful life, then in the last year, they've already applied the mid-month convention for us. We just have to apply it ourselves if we dispose of the asset in one of these middle years. All right, so this is an introduction to cost recovery and our depreciation methods and conventions.